Okay, why do some of our clients want to do swaps? One major segment of the clientele is mortgage servicers. And this is a revenue hedging thing, which is one of the tougher concepts, but I'll just briefly kind of touch on it. Basically, a mortgage servicer makes their money when they buy an asset, which produces a fixed income, a fixed stream of income over the years as long as you have that asset. The problem with that asset is it's going to come and go depending upon what interest rates do because there's a prepayment component to a mortgage. So if the mortgage gets prepaid, that asset disappears, and all of a sudden your stream of income that you think was there for 30 years disappears. So what the mortgage servicer would do an interest rate swap. So to say if interest rates go much lower and that asset gets prepaid and disappears, is this going in and out or can you hear me okay? Sorry. If that asset disappears, their stream of income will disappear, and they don't want that to happen. So if suppose they look at all their future earnings and it's going to be worth, $100 million, and they know that that asset will disappear if interest rates go 100 basis points lower, they'll put it on an interest rate swap, which will produce $100 million worth of income if interest rates go 100 basis points lower. So that's, in a nutshell, what mortgage services try to do. They'll manage that down to, to the penny. The systems they have now to manage that prepayment risk and things is pretty sophisticated, and we won't get into that right now. Something a little easier is a corporate client. Corporation, basically say IBM or any other major corporation. They undertake, say, a new investment in, let's say, Brazil. They need to build a plant down there. They figure the expected life of the plant is going to be 30 years, and they need to basically fund that plant. So they'll come out with a bond issue to fund that plant, and they know that the income stream will basically last over 30 years. But suppose the market right now for IBM debt is very attractive for them in 5 years. So if they issue a 5-year piece of paper, they could do it at a much, much lower rate. But they know that their potential asset they're building is 30 years. So what they'll do is an interest rate swap that'll basically extend that asset out from 5 years to 30 years to match, extend that liability out from 5 years to 30 years to match their potential earning asset. And, corporations do that all the time. Sometimes, a lot of times they just want to manage that, fixed rate debt and bring it back to floating rate. And it's easier for them, kind of like we were talking about the retail bank. A lot of times people just want to return everything back to very short-term floating rates, and then you can match them off and manage them more effectively. Another major segment that we kind of service is insurers. Insurers have these, basically they take premium in up front. They invest that premium in different assets, and they pay it out if there's a reason for them to pay out. The way that they really manage the payout process is they have actuaries come in and they say, okay, say it's life insurance. Let's say the average lifespan of a male is 75 years, 80 years. They'll look at all the policies that they've sold to men, kind of anticipate what the payout's going to be over time. And what they really want to do is take the assets that they have and transform the maturity of them to match what they're going to have to pay out. So they'll use interest rate swaps to do that. Maybe they'll buy that 5-year IBM bond, but they also have a 30-year payout on somebody who, they think is going to live for 30 years more. They'll come to a market maker such as ourselves, and IBM hopefully will come to us as well. They'll both do interest rate swaps, pass them through us, and we'll take a very small kind of premium in between to put that trade together. All right, so that was kind of the major types of clients we have, why we want to do a swap. These are briefly just different trades, and this will be pretty quick. First one here is a steepener. So the solid line is where the market is presently. Dotted line is kind of what the trader's opinion is, where it's going to go to. And it's basically just the change in the shape of that curve is what we're trying to capture. And you put a steepener on in this case because you think that's where it's going to go. It's fairly self-explanatory. A steepener in terms we deal on the interest rate. You basically are going to pay fixed because you think that the longer term fixed rate, say in the 5 year sector, is going to go higher. So you're going to pay fixed in 5 years. You're going to receive fixed in 2 years because you think that that is going to go lower. And then in the once the market moves, you'll be able to take that trade off at a profit. The opposite here is the flattener, where the market is currently the solid line. We think the curve is going to move the other way, and we want to take advantage of that movement. Similar mechanism that we spoke about with the steepener, but the other way around, different sectors of the curve. If you put both of those together, you get a fairly interesting trade here called a butterfly trade, where this is what we were talking about before, where a relative value account might want to come in and do a butterfly because they have both of the first two views we spoke about in different sectors of the curve. So if you look at, say, the movement between these 2 points in the 2 years, the movement here in the 5 year, and the movement in the 10 year, and you net them out, on average, maybe they really don't move that much. And if you just have a straight rate view on, you might not make that much money. But if you put the butterfly trade on and you take advantage of the two trades moving in different directions, the steepener in the 2s, 5s, the flattener in the 5s, 10s, you actually capture the difference on all three of these. And, like I said, that would be kind of a relative value type trade where they believe that the 5 year sector is really misvalued relative to 2s and 10s. Another very common trade we do in the interbank swap market is a spread trade, where this is basically a basis between U.S. Treasuries and interest rate swaps. For the different sectors of the curve, these are the two different yield curves. So this is the Treasury curve, which is generally at a lower yield. Historically, it's been at a lower yield than swaps. Over the last couple of years, in the longer end, beyond 10 years, we kind of left that off right now to avoid the confusion. That is actually inverted due to market reasons. The reason we would trade swap spreads is really twofold. One is to focus particularly on the difference in the different curve sectors between these two curves, which is fairly minute. But the other major reason is it's actually the movement in those two is a lot less volatile. So suppose somebody wants to do an interest rate swap and they need to get an approval to get that done, but the market's moving all over the place, up and down.